Good afternoon, everyone. Thanks so much for joining us today. My name is Stephanie Creedon, and I'll be your host for today's webinar, a Revenue Recognition Part 3, Cost to Acquire, Cost to Fulfill. Before I introduce today's presenters, I'd like to go over some housekeeping items. Today's presentation will last about 45 minutes, and we will have time for questions. The slides can be downloaded at www.wolfandco.com/webinars/2018. You have two options for audio today. You may dial in by phone or listen through your computer. Our audience will be muted during the session, so if you do have questions at any point, please send them in to me by using the questions box located on the webinar's control panel. I'd now like to give a brief background of the firm. Wolf & Company was established in 1911 and have 2 centuries of experience providing our clients with assurance, tax, business consulting, and risk management services. We have over 250 professionals working for the firm and have offices in Boston and Springfield, Massachusetts, Albany, New York, and Livingston, New Jersey. It's now my pleasure to introduce today's presenters, Scott Goodwin and Cecilia Frouette. Scott serves as a member of the firm and Technology Services Team Leader. Cecilia is an Audit Principal and Software Sector Leader. Thank you both for presenting today, and I'll now hand the presentation over to Scott to get started.
Thanks, Stephanie, and thanks to everyone for joining us this afternoon. As Stephanie alluded to, this is the third in a 4-part webinar series that we're putting on the new revenue recognition standard. So what we'll start with now is just the agenda for our time together this afternoon. So we're going to start just by sort of orienting everyone as to where this particular guidance sits within the revenue recognition 5-step model, and then in the broader sort of codification. I'm going to talk about some scope items, what's in scope, what's out of scope for these topics. Then we'll jump into the costs to obtain a contract. Cecilia is going to cover the cost to fulfill a contract. And then we'll talk about some of the amortization issues and impairment issues, and wrap up with hopefully some questions from you, and even more hopefully some answers from us.
All right, so the 5-step model. So we start with an overview of the model in each webinar, and we usually identify where we are in the 5 steps. So the first 2 webinars we really covered steps 1 through 4. And you'll notice that none of these steps actually have the word cost in them. So we are not actually in 606 today. Today we're spending our time in 340. So 340 is titled Other Assets and Deferred Costs. And so when FASB was putting together 606, they made a small reference within 606 to 340 where they discuss contract costs, cost to obtain and cost to fulfill. So that's where the guidance lies that we'll be discussing today. It's within 340-40. Other notes is that similar to existing guidance, or what I call old GAAP at this point, this is an improvement, and I think Scott will discuss some of the clarifying points that have been made by FASB, but this is an improvement to what's been out there, what we previously had. Now we have a little bit more guidance on capitalizing costs. And I guess before we move away from the 5-step model, I'll just highlight that our 4th and final webinar is going to be talking about step 5, recognizing revenue, and we'll also talk about licenses of IP.
All right. So yeah, as Cecilia alluded to, the intention of this new guidance isn't for this to be a comprehensive set of new accounting guidance, although there was not really a lot of guidance in these areas. The SEC had issued some. There was some miscellaneous guidance scattered throughout the GAAP. When we're talking about this new guidance, the intention was really to sort of fill in some of those gaps in the current guidance to improve consistency, because there was definitely some diversity in practice out there, and then just provide more explicit guidance overall. And the interaction with the existing guidance, so what sort of existing guidance am I referring to there? There are lots of places that may get touched on. So things like startup costs, inventory, internal use software, external use software. So how this new guidance interacts with that is that you need to consider all of the existing guidance first. So only those costs that are not covered by any of those other pieces of guidance need to be considered under this guidance. So what that means is that you don't have to do sort of a multi-step analysis. So for example, if you have some costs that you have concluded represent internally developed software costs, and you conclude that those costs do not need to be capitalized under those internal use software rules, you then don't need to take a second step and evaluate those costs under this new guidance. If the costs meet the definition or criteria for any of the existing new guidance, you do not get to this new guidance. Okay, so we've got a little decision tree here that I'll walk you through that kind of lays out for you the criteria for identifying costs to obtain a contract and costs to fulfill a contract. So we'll start in that upper left-hand corner, and the first thing we're going to do is to determine if the costs would have been incurred regardless of whether the contract was obtained. And you will move clockwise to the right. So that concept is the essence of incremental, and incremental is the first important concept to get a grip on, because if the costs are not incremental, they are definitely not costs to obtain. But if we continue to work clockwise there, if you have concluded that the costs would not have been incurred if the contract was not entered into, then you have concluded that those costs are incremental. You're not done yet. You also need to evaluate whether those incremental costs are expected to be recovered. So only if you can conclude yes to that would you have a cost that would be eligible for capitalization as a cost to obtain a contract. If you conclude that they are not recoverable, it's expensed as incurred. Now, if we can go back to the top left again, but this time you conclude that the costs would have been incurred regardless of whether the contract was obtained. So now working down that left-hand column, you then need to evaluate those costs for the various criteria for capitalization as a fulfillment cost. And I think Cecilia later on has got a sort of similar decision tree that blows out that box. But similarly, if the answer to that question is no, the costs are neither costs to obtain nor costs to fulfill, and they are expensed. If the answer is yes, they are eligible for capitalization. So just a couple of the important concepts there. In order to be a cost to obtain, it must be incremental, and we're going to get into some more details about what that means. The costs have to be recoverable, and then even if it's not incremental, that just means that it's not a cost to obtain. You still need to evaluate whether it's a cost to fulfill. So let's dig a little deeper into this concept of incremental. So what costs to obtain a contract are considered incremental? Only costs that are actually triggered by the execution of the contract by both parties are incremental. I think of this concept of incremental as being that sort of magic moment when you, the vendor, have signed the contract and you slide it across the table and the customer executes the contract. And only the costs that arise from that second signature on the contract would be considered incremental. So if you think about that, any costs incurred before that magic moment would not be considered incremental. Another way to think about it is what costs would be avoided if the customer decided at the very last possible moment that they were not going to execute the contract. So all the time that the salesperson had spent to that point, all the legal expenses that may have been incurred drafting the agreement, travel, out-of-pocket expenses to fly around the country, wooing this potential customer, none of those costs would have been avoided if the customer decided at the last minute not to execute the contract. Therefore, none of those costs could be considered incremental.
So Scott, it seems a little counterintuitive not to capitalize costs incurred before a contract is approved. Doesn't that leave out a lot of costs?
Yeah, I think it certainly does leave out a lot of costs. I mean, I think the intention of this guidance was not to take all of sales and marketing costs and some G&A costs and a whole bunch of costs and hang them up on the balance sheet. And when you go back and think about some of the things we talked about in the scope, this is really intended to be narrowly focused, and very specific. So, which is why this concept of incremental is so important. I think the intention was to capture only a very narrow set of costs that are most directly tied to and triggered by the actual execution of the contract. Okay, so we've got a little question here, so I'll just quickly run through sort of the facts that are outlined here. So you've got a multi-year SaaS agreement. Let's just assume for sake of the discussion it's 3 years and that each year is billed annually. The salesperson is paid their commission as the customer is billed, and there's no performance requirements for the salesperson after obtaining the contract. That is, they do not need to continue to be employed in order to receive those subsequent years' commissions. So is the entire commission an incremental cost of obtaining the contract at contract inception? And the answer to this question is yes. So this is really a question about the timing. The timing of the payment is not determinative here. If the salesperson if there's not any additional performance requirement on the part of the salesperson, then that is an incremental cost. So just a few things to point out that kind of come out of this example. The first is that ASC 340, the area of the codification that Cecilia pointed us to, really only deals with the debit side of the entry. The credit side, and by that I mean whether or not it's a debit to expense or it's a debit to an asset, the credit side, the liability side, is really determined by other guidance. And the asset side is determined by the liability side. So only if you have an obligation that would meet the definition and the requirements for recording a liability is it possible for you to have an asset. So in this case, if you think about what liability you'd record as a result of this, I think it's safe to say this salesperson has earned that commission. They've done everything they need to do to receive that commission. The only thing that's remaining is the timing of the payment. So you would most likely record that full liability on the date the sale closed. Also, I would say that even if the company had a pattern of not paying commissions, if a salesperson left between the time the sale was closed and the time the commission was payable, I don't think that would change that analysis. I think the only thing that would change the conclusion here would be if for some reason that payment became legally unenforceable. And, obviously you'd have to look at what's in the sales plan and in your contract with your salespeople, et cetera. But simply just having a pattern of not paying these commissions wouldn't get you out of recording either the liability or, in this case, the asset. The final minor point I would make is that if this commission is paid out over an extended period of time, you'd need to consider the need to discount the liability. And I point that out just because we just covered the amount of the liability is what determines the amount of the asset. So something to keep in mind there as well. Okay. So is a payment that depends partially on obtaining a contract an incremental cost? And the answer here is no. And if you sort of think back to what we described as the definition of incremental, it has to be tied to only the execution of the contract and no other aspects. So in this case, if the payment depends on anything else, then it wouldn't be considered incremental. So even if you had a fixed amount that would be that's based on something like an assumed sales level, for example, a manager gets a quarterly bonus based on sales activity. That sales activity is not tied to obtaining a contract per se, so that would not be incremental costs. And then payments tied to any other sort of operating metric, whether it's EBITDA or operating income or even specific customer profitability, would not be considered incremental, again, because it's not tied to that magic moment of obtaining a contract. Okay. So here we have another scenario. SaaS company signs a 3-year SaaS contract with a customer. The salesperson earns, whoops, I skipped one. So our commissions that are payable based on obtaining a contract, they're also require additional performance by the salesperson incremental. So the answer in this case is it depends. And think back to the discussion we had about the liability. So if you have a liability that needs to be recorded, then you have an asset to be recorded. So if there's additional service to be performed, then you probably would not have a liability. So then you would not have the asset. And we're going to walk through an example that's going to go into a little bit more detail for a scenario similar to this. Okay, so scenario one. So this is the scenario where the SaaSco enters into a 3-year contract with a customer. The salesperson earns a $60,000 commission. That commission is payable in 3 annual payments of $20,000 each. The salesperson needs to continue to be employed to receive the second and third payments. So what's the accounting for the SaaSco's commissions? So remember, the first we need to figure out what the liability would be that would have to be recorded on that date. And since the salesperson needs to continue to be employed, what you essentially have is what I think of as like a double trigger for that second and third installments. The first trigger would be obviously the closing of the sale, and the second trigger would be the salesperson continuing to be employed by the company at the time those second and third installments are payable. So therefore, on the date the contract is signed, you would only record a liability of $20,000. So clearly, this $20,000 would be considered incremental. When and if the second and third installments are earned, they would not be incremental and would be expensed at that time. So basically, your entry would be on the date the contract was signed. Your entry would be to debit the contract asset for $20,000 and credit the accrued commission for $20,000.
So then, Scott's clarifying point here. So let's say that the salesperson was entitled to the full $60,000 on the date of the signing, but it was paid out annually, so it was still paid out 2020. In that scenario, if I'm following correctly, the full $60,000 would be capitalized.
Right, that's true, and that sort of goes back to that question that we had that relates to the timing of the payment. The timing of the payment does not impact the conclusion as to whether or not it's incremental. In that case, the salesperson would have earned that. It would have been triggered exclusively by the fact that the contract with the customer was entered into. There are no additional service or performance requirements on the part of the salesperson, so that would be a $60,000 liability and a $60,000 contract asset. Okay, so scenario 2, SASCO's VP of Sales receives a quarterly bonus based on meeting a specified revenue target that's established at the beginning of each quarter. Is the quarterly bonus considered an incremental cost to obtain the contract? So in this case, it depends. If the bonus is based on factors other than obtaining the new contract, it's not going to be incremental. If it's based solely on obtaining new contracts, then it would likely be considered incremental. It would be essentially a delayed commission payment. And the one thing I'll point out on this one, because it dealt specifically with revenue, was that even if you have a pure revenue metric, and you may say, well, clearly that revenue metric is tied to obtaining new contracts, that doesn't necessarily make it incremental. I mean, a revenue metric in any particular period could be based on contracts obtained the prior year, 5 years prior. So if there's a pure revenue metric, then there's a commission or any cost tied to that revenue metric, it's probably not going to be incremental. In order for it to be incremental, it would really need to be closer to a bookings concept as opposed to a revenue concept. So at this point, you're probably starting to think about what a logistical nightmare this might be for you to track and record all this stuff. So the bad news is that this is not a policy election. And by that, I mean you can't just elect to not apply this guidance and just say, I'm going to be quote unquote conservative and I'm going to expense all these costs to obtain a contract as incurred. That is not allowed. The good news is that there is a practical expedient. And what that practical expedient allows is that you are not required to capitalize incremental costs if the amortization period would be 1 year or less. And a couple of important things to point out there. The guidance in the practical expedients refers specifically to the amortization period, not the initial contract term or any other term. And Cecilia is going to talk about the amortization period, and not to be a spoiler, but there are definitely situations where the amortization period is longer than the initial contract term. So you can't just say, oh, all my SaaS contracts are 1 year, therefore this doesn't apply to me and I can expense everything. Another thing to keep in mind, this practical expedient only applies to costs to obtain, not costs to fulfill. And the practical expedient itself is a policy election. And what that means is if you feel so inclined, you are free to capitalize all your costs to obtain and not apply this practical expedient.
All right, so now we're moving on to cost to fulfill. So again, we have a decision tree in front of you to help us move through the process. But before we focus in on that, just in general terms, really wanted to highlight that the costs of fulfilling a contract include any costs incurred to provide the promised good or services to a customer. So these are, your cost of sales and your cost of goods sold. And as software companies are keenly aware, sometimes costs can be incurred at the same time that revenue is recognized, but frequently they are incurred in a different pattern or time frame than when the related performance obligation is satisfied. And this has been an issue in the past. And hopefully the guidance here clarifies the accounting issue and provides some rationale on when to capitalize and when to expense cost of sales. So if we look at the decision tree, the first question here is, are the costs covered by other guidance? So as Scott highlighted in the scoping slide, the new guidance is not intended to change the accounting for costs that are addressed by other parts of GAAP. So we think of costs related to inventory, internally developed software, intangible assets, R&D costs. All these costs have relevant guidance, and 340-40 is not intended to alter accounting for these costs. So if the costs are not covered by other guidance, then you can move on to the next question in the decision tree and look at the requirements of costs to fulfill. The first being that are the costs directly related to fulfilling the contract? Then it asks, do they generate or enhance resources needed to deliver a promised good or service? And finally, are the costs recoverable? So if we answer yes to all three of these questions, then you are going to capitalize costs under 340-40. So I do have a few more slides that discuss direct costs coming up, so I'll hold off on expanding on how we define the important concept of direct, and just touch briefly on the other two criteria. So a few conceptual points when thinking about the costs that generate or enhance resources. It's really important that the costs of activities that are incurred in the act of satisfying a performance obligation are not capitalized. Really what we are looking for here is costs that are incurred ahead of the delivery of the performance obligation. So for software companies, setup costs that are required on the contract but do not immediately satisfy a performance obligation would be an example of a cost that generates or enhances resources in order to allow the company to satisfy performance obligations in the future. There could also be a scenario when you're looking at costs that you can't make a determination if the costs relate to an unsatisfied or partially satisfied performance obligation. So if there's any doubt as to, do the costs support a performance obligation that's partially or fully satisfied, then you just have to expense the related costs. And then on recoverability, this is really not a new concept. The criteria really applies to any time you capitalize an asset. Ultimately, it has to be recoverable back to the company. So for purposes of fulfillment costs, determining that the costs are expected to be recovered would really involve reviewing the contract to see if the costs are going to be directly reimbursed or if there is sufficient expected profit within the contract. So if we go to the next slide, now we're getting into the details of what costs may be capitalized. So costs of direct labor and materials, of course, can be capitalized, and then you can do an allocation of direct costs. So insurance, depreciation, costs such as that nature can be capitalized. Costs that are explicitly charged back to the customer under the contract. So here I think about reimbursable expenses, if they're specifically laid out, can be capitalized. And then really any other costs incurred only because the entity entered into the contract and needs to fulfill the contract. So your subcontracting costs, your third-party costs, may also be considered direct and be capitalized. So a comment here on distinguishing what makes a cost direct. So there's an example within the guidance that I wanted to share with you. So there's a scenario where the cost of designing a product improvement that the company anticipates it will incorporate into its products and be sold to many customers and be beneficial to many customers would not be eligible for capitalization, even if the product improvement effort was triggered by a provision in a customer contract. So if the improvement is going to be universally shared, it's even though it's direct and comes from a customer contract, it's not capitalizable. So contrast that with the example of costs of designing a product that is specific to a customer contract and where the product design will be owned by the end customer. That would meet the definition of direct and be capitalizable. So then the next slide goes on to talk about costs that may not be included. So no surprise here with the first two. So general and administrative costs generally are not capitalizable. There is a little exception here if general and admin costs are specifically referenced within the contract as being reimbursable, then you may be able to capitalize them. But generally speaking, you're not going to capitalize G&A costs. And then costs of overages or wasted materials. that kind of makes sense, and I think it really gets back to recoverability and the fact that these costs are really not going into the ultimate product or service that's going to get transferred to the customer. It's really just wasted time or materials. And then the last 2 points I touched on briefly before. So costs related to past performance. So a satisfied performance obligation is not going to be capitalized. Again, we're really looking for costs that are incurred ahead of delivery of the performance obligation. And the other point, costs that are not distinguishable between performance obligations. So if you can't tell if the cost is related to a partially satisfied or fully satisfied performance obligation, then you have to expense. So we'll move on to the next slide. So a question on, are direct costs incurred in satisfying a present performance obligation eligible for capitalization? So as you may have guessed, generally no. So in order for fulfillment costs to be capitalized, the cost must generate or enhance resources of the entity that will be used in satisfying performance obligations in the future. So you can't capitalize if you're presently satisfying the performance obligation. So this leads to a question of, what about contract costs incurred in fulfilling a performance obligation that's satisfied over time? So these are expensed as incurred, even if that results in recognizing fulfillment costs ahead of recognizing the related revenue. So think about that. That might occur, if the entity determines an appropriate measure of progress for the performance obligation is a measure that's other than a cost to cost. So your fulfillment costs could therefore be greater in the earlier or later stages of the project and not follow along perfectly with the revenue you're able to recognize. So let's look at an example. So scenario 3, so Samplico enters into a contract to provide a customer with access to a SaaS platform for a term of 3 years. As part of the contract before commencement of the SaaS term, Samplico will set up the user interface that the customer will need to access the online application, and it will also undertake data conversion and migration activities for the customer to configure and move its relevant existing data from the customer's current on-premise solution to Samplico's hosted environment. And then lastly, Samplico will provide training to the relevant customer personnel for efficient use of Samplico's hosted application. So how would we look at this scenario? So Samplico is going to conclude that the user interface setting up the user interface is a setup activity rather than a promised service to the customer, because it provides no incremental benefit to the customer beyond permitting the customer access to the hosted application. So consequently, assuming that the setup activities are directly identifiable to the contract with the customer and are expected to be recovered, Samplico will capitalize a contract asset for those setup costs. The data conversion and migration activities are services that will be provided to the customer with incremental benefits beyond just the hosted application. So the data conversion and migration activities would otherwise need to be performed by a customer or another service provider. And it permits the customer to more effectively use the hosted application. Similarly, the training of the customer's personnel is also a promised service, because the training will permit the customer to effectively use the hosted application. So the data conversion, migration, and training services are distinct from the SaaS platform. So because the data conversion and migration activities and the training are promised services, and assuming that both the services are satisfied over time, the costs of fulfilling the services do not qualify for capitalization and are expensed as incurred. So now we're going to talk a little bit about amortization and impairment. So, what are we trying to achieve with amortization? And that's really that the expense is being recognized on a systematic basis that's consistent with the transfer of the goods or services to the customer. And really, that's done so we're recognizing the expense. We're really essentially matching the revenues and expenses if we're able to achieve that. And the guidance goes further and says, in the event that costs are related to 2 or more performance obligations with a different pattern of transfer, You can either, allocate that contract cost on a systematic and rational basis to those performance obligations, or you can look to a single measure that best reflects the use of the asset as the goods and services are transferred. So you do have some options there if your costs are related to more than one performance obligation. But again, what we're really trying to get at is really more about a matching of the amortization expense to the revenue and that transfer of the goods or services to the customer.
So before we leave this, Cecilia, I think we promised that we would circle back to that scenario 1 and talk about the amortization of that in that case. So just to remind people, that was the situation where the salesperson was entitled to 3 payments of $20,000 each, and that salesperson needed to continue to be employed in order to get payments 2 and 3. And in that case, we concluded that the incremental cost to obtain the contract was solely that first $20,000. And the question was, well, over what period would you recognize that $20,000 cost to obtain the contract? And in this case, the amortization period for that $20,000 would be the 3-year SaaS term. And it actually could be longer if there were renewals that were specifically anticipated. And I think that's a concept Cecilia is going to touch on maybe on the next slide. And that 3-year period really is consistent with the transfer of the SaaS, and that SaaS is the thing that triggered the incremental cost. So in that sense, the 3-year amortization period for that $20,000 makes sense. Now, I can certainly see why some of you might be shaking your head, because in years 2 and 3, you're going to have closer to $27,000, assuming the salesperson stays and gets their commission in those periods versus $20,000 in year 1. I mean, I guess the argument would be is that first $20,000 relates to the 3-year SaaS. The second and third $20,000 not only relate to that 3-year SaaS, but they also relate to that performance that the salesperson provided during each of those additional years of service, because this was sort of a double trigger scenario. So although it may seem counterintuitive, I think that's sort of the logic for why the incremental cost gets recognized over the full period, whereas each individual subsequent payment would be amortized would be recorded when the liability was recorded in each of those subsequent years.
Okay, so the next we put up a question, which I think is kind of a natural question for software companies, which is when should capitalized costs be amortized over a period that is longer than the specified contract? So should we include specifically anticipated renewal periods? And the answer is yes. The amortization period for a contract cost asset should include those specifically anticipated renewal periods when the entity concludes that it will continue to benefit from the contract cost of the asset. So, we need to consider, renewals need to consider, if they're specifically anticipated. And I would also add that these renewals would generally not have an additional outlay of costs to obtain or fulfill in order to keep amortizing over that longer period. Because if you had an additional outlay of costs upon renewal that is commensurate with the cost that is paid or incurred on the initial contract, then the amortization period should not be extended to renewals.
Yeah, and Cecilia is touching on an area here that does get a little complicated and is probably beyond the scope of the 1 hour we have today. But I'll just tell you, if you have a commission scenario where you pay a larger commission rate or dollar amount in year 1 than you pay in years 2, 3, and 4. For example, you pay 10% in year 1, and then you pay a sort of renewal rate of 1% in each subsequent year. You're going to have to look very carefully at how that initial 10%, if it is determined to be an incremental cost to obtain, how that initial commission gets amortized. It gets very tricky in this whole concept of whether the amounts paid in subsequent years are commensurate with the effort for the salespeople.
Yeah, and the last comment I'll make here is that, another question that periodically comes up is, should you just amortize over the average customer life? And I caution here that that's not necessarily a good idea. And the reason being that the average customer life for a company's goods or services may be inconsistent with the amortization guidance, which requires us to recognize revenue or recognize expense over the transfer of over the period of transfer of goods or services to the customer. So you could have a situation here where the entity could have a very long average customer life, say 15 years, but the software that's being transferred to the customer could have an economic life substantially shorter than, say, 5 years. So it wouldn't necessarily achieve a good result amortizing over an average customer life.
Right.
So I think we have another scenario here. So for amortization, so SampleCo enters into a 1-year contract with a customer to provide data management services through a SaaS platform for an amount of $10,000 per month. SampleCo incurs the setup costs of $15,000 directly related to the contract. The setup costs are not incurred again if the subscription is renewed by the customer. And then SampleCo anticipates, based upon relevant customer specific facts and other relevant circumstances, that the customer will renew the contract for an additional 3 years. So how would we look at amortization in this case? So SampleCo will conclude that its setup costs of $15,000 are directly related to the customer contract and are recoverable by the margin it expects to earn on the contract and the specifically anticipated renewals. SampleCo would further conclude that the setup activities enhance its resources that are necessary to provide the services. Therefore, it would capitalize these costs as contract cost assets. And because SampleCo anticipates that the customer will enter into 3 one-year renewals beyond the initial 1-year contract, and it will not incur similar costs to obtain or set up, will not incur similar setup costs. Therefore, SampleCo expects to be able to benefit from these initial setup costs over the 4-year term and will amortize these $15,000 over the 4-year term. I think Scott's going to talk us through some impairment considerations.
Right. Yeah, it seems that no accounting discussion these days would be complete without touching on the impairment concept, and we have some here. So, as you would expect with any asset, cost to acquire and cost to obtain assets do need to be considered periodically for impairment. Fortunately, I think the model is fairly simple. So you would recognize an impairment if the carrying amount of the asset exceeds the recoverable amount, and the recoverable amount is defined by the difference between what you expect to receive from this customer in the future, plus what you have received from this customer already but haven't recognized yet as revenue, less what the direct costs that you would have to incur to complete that performance obligation that have not been recognized as expense. So either you haven't incurred them yet, or they are the expenses that you have already incurred and are sitting on the balance sheet. So if you determine you have an impairment, you take that right down at that time. So a few thoughts on this. There are certainly cases where customers may, intentionally enter into a loss contract, whether it's a new product or you're going after a new customer segment. And that probably wouldn't get to be an impairment issue, because if you think about our decision trees, those costs probably never would have been recoverable in the first place. So hopefully you wouldn't have capitalized them. Second of all, if you do end up recording an impairment, as with most other impairments, they cannot be reversed. So you can't say in year one, geez, this is a terrible contract, we're going to lose everything and take an impairment loss and have things turn around in year two and reverse that impairment. It's a permanent impairment. So just thinking practically about when we might expect to see impairments come up, I think it's actually going to be a fairly narrow range, at least in the software space, and most specifically in the SaaS space, just because I don't think, there aren't that many direct expenses related to satisfying performance obligations for these types of companies. So it's going to seem unlikely that expense piece is going to exceed the amount you expect to receive. The only scenario I could come up with where it might come up would be if you're doing some sort of significant software customization project. You bid that on a firm fixed price, and turns out it's going way over budget. That could be one scenario where you end up with an impairment. One other thing I'll just point out about that first bullet there and the expected future consideration you expect to receive from the customer, that definition ties back to the transaction price concept that is in step 3 of the revenue recognition model. So it leverages that concept with 2 exceptions. The first is that there's no constraint on the variable consideration. And if you were at session 2, you're an expert in constraints on variable consideration. And the second exception is that you would factor in credit risks related to a customer. So in this case, if you had a customer where your second year billing was going to be $1 million, but you knew that this customer was having significant credit issues, and you were concerned about collecting that factor would play into this impairment analysis, where it doesn't in step 3 in determining the transaction price. So I think we're right at the 245 mark. Am I right, Stephanie?
Yeah, right around there, 247.
Okay. So questions. So Cecilia, I got a variant of a question that I've gotten before from clients and prospects, and that has to do with whether any of this guidance impacts the existing guidance on the capitalization versus expensing for software development costs, either internal use or software to be sold.
Right, so there's been no changes to the software development rules. So the intent of 340-40 was, not to change the existing guidance. Just so the answer to that would be no. So
no change.
No change.
No change is good change. Okay, let's see. I got one that says, our company pays a certain portion of the commission when the contract is signed and the remainder when the customer has paid. How would these costs to acquire be handled? So I have certainly seen that. I've also seen situations where the entire commission is deferred until the customer pays. As I have in the past, I guess I would start by going back to the concept of what liability would you record in that case. So if the salesperson is entitled to the commission, if the customer doesn't pay, then it seems like you would have a liability. If the salesperson's right to receive that commission is entirely tied to the customer paying, it wouldn't seem like you would have a liability on the date the contract was signed. Practically speaking, even if there's a service requirement for the salesperson in that window between when the contract is signed and when the bill goes out and is collected, if that period is not significant, you could probably conclude that service requirement was not substantive. And in that case, you could probably even make an argument just for sort of simplicity and practicality's sake to record the entire commission liability at contract inception. But you'd certainly want to evaluate carefully what that time between contract inception and when the expected payment date is.
And that's kind of, I see another one come in related to cost to obtain. So the question here is, what if I give away a 30-day free trial of my software? Is that a cost to obtain a contract?
Okay. I go back to my magic moment concept, and that seems like you would have already given away that 30-day free trial before either party signed on the dotted line. So I'm going to put that in the bucket of costs that are incurred before the magic moment. And certainly if a customer does go ahead and sign up after that 30-day period, that is a cost that would not have been avoided if at the last minute the customer had decided not to execute that contract. So in that case, I would conclude it is not an incremental cost and therefore not a cost to obtain a contract. I have one here about contract renewals. So there are a couple on contract renewals. So the first is, how are commissions for contract renewals handled? So I guess I would just make a distinction. So it's one thing to have a 3-year SaaS contract that you bill annually for 3 years. That is one contract, and those interim billings would not be renewals. But at the end of that 3-year period, if that SaaS contract renewed for either another 3-year period or a 1-year period, that would be the true renewal. And I would say commissions for the case in the situation of a true renewal would be handled exactly the same way commissions on the initial contract. They would be evaluated to determine if they're incremental and in the exact same way that the original commission was evaluated. A renewal is no less of a contract with a customer than it is with a new customer. So if you then went through the analysis and determined that that commission was incremental and recoverable, then it would be capitalized as a cost to obtain. The other question related to renewals had to do with the practical expedient and whether that could be applied to renewals, and the answer to that is yes. In fact, in this case, as Cecilia pointed out, in the initial contract, you may, because of specifically anticipated renewals, conclude that the amortization period is longer than a year and therefore you're not eligible for the practical expedient. When you go to do a renewal, you may find that the renewal is eligible for the practical expedient when the initial contract was not. So yes, the practical expedient is available for contract renewals. Anything else come in while we were
nope,
chatting?
No additional questions come in.
Okay.
Okay, great. So it looks like our time is now up. If you do have any additional questions following the conclusion of this webinar, please reach out to Scott or Cecilia directly. Scott, if you could just forward your screen. Their contact information is listed on the current slide. Copies of today's presentation are available at www.wolfandco.com/webinars/2018. I will also be posting a recording of this presentation to the same web address later on today. As a reminder, this webinar is part of a 4-session series. Part 4 will be taking place on Tuesday, July 24th at 10 a.m. on the topic of license of intellectual property. Immediately following the conclusion of this webinar, you will have the opportunity to complete a survey. As always, we appreciate your feedback so that we can continue to improve our webinar program. Thank you so much for attending today, and we look forward to your participation in future webinars. Have a great afternoon, everyone.
Thank you.